Ladies and gentlemen, let me ask you something. What if the next 24 hours could change how the world looks at silver forever? What if, while most people are sleeping, the market is quietly loading a spring so tight that when Monday arrives, it snaps? Today, we are standing at the edge of a moment investors wait years for. The clock is ticking. 24 hours left, and the words echo across trading floors and timelines alike: silver, gamma, squeeze. In modern financial markets, a gamma squeeze represents one of the most powerful yet least understood mechanisms driving sudden and aggressive price movements. At its core, it emerges from the structure of the options market, not from emotion or speculation alone, but from mathematics, obligations, and forced behavior. When investors accumulate a large volume of call options on an asset like silver, they are not merely expressing optimism. They are creating pressure within the system. Market makers, whose role is to provide liquidity and remain neutral, must hedge their exposure. As the price of silver begins to rise toward key option strike levels, these hedging requirements increase rapidly, turning a manageable situation into an accelerating chain reaction. This is where attention becomes opportunity. Gamma, the rate at which an option's delta changes as price moves, is the silent driver behind this phenomenon. When gamma is high, even small increases in silver's price force market makers to buy disproportionately larger amounts of the underlying metal or related instruments to maintain balanced books. What begins as a modest upward move quickly transforms into a self-reinforcing cycle. Price rises demand more hedging, hedging pushes price higher, and higher prices demand even more hedging. The market, in essence, starts chasing itself. This is not driven by hope or headlines, it is driven by obligation. And obligation does not hesitate. The true intensity of a gamma squeeze becomes evident near heavily populated strike prices, where open interest clusters act like gravitational zones. As silver approaches these levels, the hedging curve steepens dramatically. Every tick upward increases exposure at an exponential rate. This is the moment when markets shift from rational movement to mechanical acceleration. Many participants see the price moving and assume sentiment is changing, but the reality is far more structural. The system is responding to pressure it can no longer absorb quietly. When awareness meets this moment, advantage follows. What makes a gamma squeeze especially potent is its speed. Unlike traditional demand-driven rallies, which build gradually as capital rotates in, gamma-driven moves compress time. Hours replace weeks. Minutes replace days. This compression catches unprepared participants off guard, forcing late reactions instead of early positioning. Those watching from the outside often ask how the move happened so fast. The answer is simple: the groundwork was laid long before the price moved. The options market whispered before the spot market shouted. In the context of silver, this mechanism carries even greater significance. Silver is not just a financial instrument, it is an industrial input, a monetary hedge, and a strategically constrained resource. When gamma pressure collides with an already tight market structure, the effect multiplies. Market makers cannot source infinite liquidity instantly, and when hedging demand surges, it exposes fragilities that are normally hidden beneath calm price action. This is when price discovery stops being theoretical and becomes urgent. Another critical dimension of the gamma squeeze is behavioral asymmetry. Early participants act from analysis and foresight, while late participants act from necessity. Market makers hedge because they must. Short sellers cover because risk models demand it. Momentum traders enter because algorithms signal acceleration. None of these actions are optional once triggered. This lack of choice is what gives a gamma squeeze its force. The market is no longer negotiating, it is executing. Perhaps the most overlooked aspect is that gamma squeezes are visible before they occur, but only to those who study positioning rather than price alone. Charts show what has happened. Options data shows what must happen if certain levels are breached. This distinction separates reactive traders from strategic thinkers. The real edge lies not in predicting the future, but in understanding the consequences already embedded in the present. When silver begins to move under gamma pressure, disbelief often precedes acceptance. Analysts scramble for narratives, headlines chase explanations, and the public arrives only after the mechanics have done their work. By then, the opportunity has transformed into a lesson. A gamma squeeze is not a surprise to the prepared, it is a scheduled event with uncertain timing, but predictable behavior. And when it ignites, it reminds the market of a timeless truth. The most powerful forces are often invisible until they are unavoidable. In financial markets, risk rarely announces itself loudly. It builds quietly through positioning, concentration, and imbalance. Options positioning risk is one of those forces that hides in plain sight, visible to those who know where to look and invisible to those focused only on price. When open interest accumulates heavily around specific strike prices, the market becomes structurally fragile. It may appear calm on the surface, But beneath that calm sits a dense network of leveraged commitments waiting for a catalyst. The moment price begins to drift toward these crowded zones, the market's behavior changes, not emotionally, but mechanically. Open interest clustering acts like stored energy. Each contract represents a promise, and when too many promises align at similar price levels, the system loses flexibility. A small move that would normally be absorbed by liquidity suddenly creates disproportionate consequences. This is where volatility is born, not from panic, but from concentration. When silver trades near heavily populated strikes, market makers face rapidly shifting exposure profiles. Their hedging strategies, which function smoothly under dispersed positioning, become increasingly sensitive as price approaches these pressure points. What was once a linear risk curve turns sharply nonlinear. The danger and opportunity of this setup lies in how quickly it can escalate. As price nudges closer to these strikes, deltas accelerate, hedging thresholds are breached, and liquidity thins. Market makers are forced to adjust in real time, often in the same direction as the price move itself. This creates an environment where volatility feeds on structure rather than sentiment. Traders watching from the sidelines often misinterpret the sudden movement as irrational behavior, when in fact it is the market responding exactly as it is designed to under stress. Crowded positioning also creates asymmetric outcomes. When too many participants are aligned on one side of a trade, the market's path of least resistance often runs against them. Protective strategies become liabilities. What was intended as leverage turns into urgency. This is especially pronounced in silver, where options markets can become tightly packed around psychologically significant levels. Once these levels are approached, the market does not require new information to move, existing commitments are enough. The trigger is not news, it is proximity. Another critical element of options positioning risk is the illusion of stability. High open interest is often interpreted as confidence or consensus, but consensus is not safety. In fact, it can be the opposite. When everyone is positioned similarly, there are fewer natural counterparties to absorb sudden shifts. This lack of balance increases slippage, widens spreads, and amplifies price moves. Liquidity, which appears abundant during calm periods, evaporates precisely when it is needed most. That is the paradox professionals respect and amateurs overlook. The psychological dimension adds another layer of complexity. As price begins to react to positioning pressure, traders who were initially comfortable become reactive. Stop levels cluster, margin thresholds tighten, and risk models adjust. Each reaction adds fuel to the move. Importantly, these reactions are not coordinated, but their effects are cumulative. The market does not need fear to accelerate, it only needs alignment and constraint. Once momentum builds, even neutral participants are forced to engage, further destabilizing equilibrium. What separates strategic market participants from reactive ones is their ability to recognize these conditions before they become obvious. Options positioning data offers a forward-looking lens, revealing where the market is vulnerable long before price reflects that vulnerability. Those who understand this do not ask whether volatility will arrive, they ask from where it will emerge and how fast it will travel. This shift in perspective changes decision-making entirely. In moments like these, markets reward awareness over prediction. The greatest moves often originate not from unexpected events, but from expected structures reaching their limits. Options positioning risk is the map of those limits. When silver approaches them, the market does not pause to reconsider, it responds. And when that response begins, it rarely unfolds gently. At the heart of every sustained market move lies a simple truth that never loses relevance. Price is ultimately governed by supply and demand. Yet in the case of silver, this relationship operates under unusually tight constraints, making even modest shifts in demand capable of producing outsized effects. Silver is not a commodity that can be easily scaled or quickly brought to market. Production cycles are long, mining output is relatively inelastic in the short term, and a significant portion of silver supply is a byproduct of mining other metals. This structural reality means that when demand accelerates, supply cannot respond with speed, creating pressure that expresses itself directly through price. On the demand side, silver occupies a unique position that few assets can replicate. It is simultaneously an industrial metal and a monetary asset, serving two masters that often pull in the same direction during periods of economic uncertainty. Industrial demand continues to expand as silver remains critical to electronics, renewable energy, medical technologies, and advanced manufacturing. Each technological advance that relies on conductivity, efficiency, or durability quietly increases baseline consumption. This demand is not speculative, it is functional. Once embedded into production processes, it becomes non-negotiable. At the same time, investment demand adds a powerful second layer. In an environment marked by currency debasement concerns, rising debt levels, and declining confidence in traditional monetary systems, silver attracts capital seeking preservation rather than performance. Unlike purely financial instruments, silver carries no counterparty risk. It does not rely on promises, balance sheets, or policy credibility. This characteristic becomes especially valuable when trust in financial architecture weakens. As investment flows increase, they compete directly with industrial users for the same limited physical supply, intensifying scarcity. What makes this imbalance particularly compelling is the absence of immediate relief mechanisms. Unlike currencies or equities, silver supply cannot be expanded by policy decisions or corporate issuance. New mining projects require years of exploration, permitting, and capital investment before a single ounce reaches the market. Recycling provides only marginal flexibility and often lags behind price signals. This creates a situation where demand shocks are absorbed almost entirely by price rather than volume, amplifying volatility and compressing adjustment timelines. The market often underestimates how quickly this tension can escalate. For extended periods, silver may trade within narrow ranges, giving the impression of abundance or equilibrium. But this stability is deceptive. It reflects delayed recognition rather than genuine balance. When demand surpasses available supply, even briefly, inventories draw down, premiums rise, and spot prices begin to respond. Once this process starts, it feeds on itself. Higher prices attract attention, attention draws new participants, and additional demand enters a market already struggling to satisfy existing needs. Another critical aspect of silver's supply, demand imbalance, is its strategic importance. As governments and corporations push toward electrification, renewable energy infrastructure, and digitalization, silver's role becomes increasingly central. Solar panels, electric vehicles, and high-efficiency electronics are not optional trends. They are policy-driven and capital-intensive commitments. This embeds future demand into long-term planning cycles, reducing elasticity even further. Supply, constrained by geology and economics, cannot match this pace without significant price incentives. The hook lies in recognizing that markets often price silver as though it were a marginal asset, when in reality it functions as a critical input across multiple systems. This mispricing creates vulnerability. When awareness spreads and participants begin to reassess silver's true scarcity, repricing can occur rapidly. The adjustment is rarely smooth because the underlying imbalance has been accumulating silently. By the time it becomes visible, the market is already behind the curve. In such environments, silver becomes highly sensitive to incremental demand. Small increases in investment allocation or industrial usage can trigger disproportionate price responses. This sensitivity is not a flaw. It is a feature of constrained systems. Those who understand this dynamic do not wait for confirmation in price charts. They study flows, inventories, and commitments, knowing that when supply and demand finally collide, the outcome is not debate, it is resolution. Liquidity is often spoken about as if it were permanent, reliable, and evenly distributed, but in reality it is conditional and highly sensitive to stress. In calm markets, liquidity appears abundant, orders fill smoothly, spreads remain tight, and price movements feel controlled. This surface stability creates confidence, sometimes overconfidence. Yet, when markets face rapid hedging demands or sudden shifts in positioning, liquidity reveals its true nature. It withdraws precisely when it is needed most. This is where volatility stops being theoretical and becomes unavoidable. In markets like silver, where depth is thinner than in major currency pairs or large cap equities, liquidity constraints play a decisive role in price behavior. When large participants are forced to transact quickly, whether due to hedging requirements, margin pressures, or risk limits, the available counterparties may not be sufficient to absorb that flow without meaningful price adjustment. Each aggressive buy or sell order consumes available liquidity, pushing the next transaction to a less favorable level. What might have been a modest move under normal conditions becomes amplified simply because there is nowhere else for the trade to go. Volatility is not born from chaos, it is born from imbalance. When liquidity providers step back, widen spreads, or reduce size, the market becomes more sensitive to each incremental order. Price begins to gap rather than glide. This effect compounds during periods of accelerated activity, such as gamma-driven hedging or momentum-based trading. In these moments, speed matters more than price for many participants. Execution replaces optimization, and urgency replaces patience. That shift alone can transform a stable market into a highly volatile one within minutes. The hook lies in understanding that volatility is often a symptom, not a cause. Traders see sharp price swings and assume new information has entered the market, but frequently the information was already known. What changed was liquidity. When hedging flows increase suddenly, especially in a market with limited depth, liquidity providers cannot maintain normal conditions without taking on unacceptable risk. Their rational response is to pull back. That rational decision, repeated across institutions, leaves the market exposed. Price must then move further to find willing participants. Silver's liquidity profile makes it particularly responsive to this dynamic. While it is actively traded, it does not possess infinite capacity at every price level. Large directional flows can overwhelm near-term order books, especially during off-peak hours or around key technical and options-related levels. When this happens, volatility does not rise gradually, it jumps. Each price move increases uncertainty, which further reduces liquidity, creating a feedback loop that accelerates the process. Another critical factor is the role of algorithmic and systematic trading. Many modern strategies are designed to respond to volatility rather than predict it. As volatility increases, some systems reduce exposure, while others increase participation to capture momentum. Both responses can intensify price movement. Reduced exposure removes liquidity, while momentum strategies add directional pressure. The market becomes less about valuation and more about flow. In such conditions, traditional anchors like fair value or historical averages lose influence. Psychology reinforces this mechanical process. As price moves faster and spreads widen, discretionary traders become hesitant. Orders are delayed, size is reduced, and conviction weakens. This hesitation further thins liquidity. At the same time, risk managers demand adjustments, forcing additional trades that are indifferent to price. The market is no longer a conversation, it is a sequence of forced actions. Volatility thrives in this environment because no single participant is in control, yet everyone is reacting to the same constraints. What separates experienced market participants from the rest is their respect for liquidity as a dynamic variable. They understand that the biggest risk is not always being wrong on direction, but being right when liquidity disappears. In silver, when liquidity contracts and volatility expands, price can overshoot both optimism and pessimism. These moves feel extreme not because they are irrational, but because the market is temporarily operating without its usual shock absorbers. When those absorbers fail, motion becomes momentum, and momentum becomes force. Market psychology is the invisible current that carries prices far beyond what balance sheets or supply models alone would justify. It is not irrational, it is reactive, reflexive, and deeply human, even when expressed through algorithms. Momentum begins quietly, often dismissed as noise, until it crosses a threshold where perception shifts. At that moment, price is no longer just a number, it becomes a signal. And once price becomes a signal, behavior changes faster than fundamentals ever could. Momentum is born when markets move just enough to attract attention, but not enough to inspire confidence. Early participants act from analysis, but as price accelerates, psychology takes the lead. Traders stop asking why the market is moving and start asking how far it can go. This transition is subtle yet decisive. In silver, where historical volatility has conditioned participants to expect sudden moves, momentum can ignite rapidly. A modest breakout becomes a headline becomes validation becomes participation. What makes momentum so powerful is that it feeds on agreement rather than evidence. As more participants observe the same directional move, their actions align even if their reasons differ. Some chase returns, others hedge risk, and others follow systematic signals. The motivations vary, but the outcome is the same: additional pressure in the direction of the move. The market begins to reward speed over precision. Being early matters less than being present. That shift alone can transform a controlled rally into a surge. Algorithmic systems amplify this process. Many quantitative strategies are designed to detect momentum, a volatility expansion, or trend confirmation. When silver crosses certain thresholds, these systems activate automatically, adding volume without hesitation or doubt. Unlike human traders, algorithms do not pause to reassess narratives. They respond to conditions. As momentum builds, more systems engage, reinforcing the move regardless of underlying valuation. This mechanical reinforcement gives momentum a durability that surprises those expecting quick reversals. The psychological hook lies in how quickly disbelief turns into fear of missing out. Early skepticism fades as price continues to rise. Those who stayed on the sidelines begin to feel urgency, not because they believe more strongly in the asset, but because they fear being left behind. This fear is not emotional weakness, it is a rational response to opportunity cost. As participation widens, the market's character changes. Pullbacks become shallower. Resistance levels dissolve faster than expected. Confidence grows not from certainty, but from repetition. Momentum also alters risk perception. As price advances, recent gains dominate memory, making downside risks feel distant or manageable. Traders adjust expectations upward, recalibrate targets, and increase size. This behavioral shift is critical because it increases sensitivity to further movement. Each new high reinforces belief in continuation. In silver, where historical breakouts have often been explosive, this reinforcement carries extra weight. Past experiences shape present decisions, and memory becomes momentum's ally. Another overlooked dimension is social reinforcement. In modern markets, information spreads instantly across networks, platforms, and communities. A price move in silver does not remain confined to trading desks. It becomes a shared narrative. Charts circulate, commentary multiplies, and conviction spreads. This collective attention acts as an accelerant. Markets do not move solely on capital, they move on focus. Where attention flows, liquidity follows, and where liquidity follows, price responds. Momentum persists not because it is always justified, but because it is self-validating for a time. Rising prices attract participation. Participation supports prices, and that support attracts more participation. The loop continues until something interrupts it: exhaustion, external shock, or structural constraint. Until then, momentum remains one of the most reliable short-term forces in markets. Those who dismiss it as emotional noise often underestimate its ability to override traditional anchors. In silver, momentum has a habit of arriving suddenly and leaving impressions that last. It does not ask for permission, and it does not wait for consensus. It rewards decisiveness and punishes hesitation. Understanding this dynamic is not about predicting tops or bottoms. It is about recognizing when psychology has taken the wheel and accepting that, for a time, belief itself becomes a market force. Risk management is the quiet discipline that determines who survives periods of extreme market behavior and who becomes a statistic after volatility fades. In gamma-driven environments, traditional assumptions about price movement break down quickly. Moves are faster, retracements are sharper, and liquidity can vanish without warning. This is precisely why risk management is not a defensive afterthought, but an active strategy. When volatility accelerates, the market does not forgive hesitation or oversized conviction. It tests structure, discipline, and preparation all at once. One of the most dangerous illusions during a gamma-driven rally is the belief that speed equals safety. Rapid upward movement creates confidence, and confidence invites larger position sizes. Yet gamma-driven rallies are unstable by nature because they are powered by forced activity rather than organic price discovery. When hedging pressure eases or positioning shifts, the same mechanics that pushed price higher can unwind just as aggressively. Risk management in this context is not about predicting reversals. It is about acknowledging that reversals do not announce themselves. Position sizing becomes the first line of defense. In high volatility conditions, exposure that feels reasonable under normal circumstances can quickly become excessive. Professionals understand that risk is not defined by entry price alone, but by how much capital is exposed to sudden adverse movement. Smaller size preserves flexibility. Flexibility preserves decision-making. This is not caution, it is control. The ability to stay in the game while others are forced out is a competitive advantage that compounds over time. Timing also takes on heightened importance. Gamma-driven moves compress decision windows, turning hours into minutes. Entering late may feel safer because the move is visible, but visibility often coincides with maximum risk. Late entries are vulnerable to volatility spikes and liquidity gaps that leave little room for adjustment. Effective risk management recognizes that not every opportunity must be taken. Selectivity becomes strength when markets are unstable. The discipline to pass can be as valuable as the courage to act. Exit strategy is where many participants fail. In fast-moving markets, exits are often emotional rather than strategic. Profits feel permanent until they aren't. Risk-managed exits are planned before entry, not negotiated during stress. This planning allows decisions to be executed without interference from fear or greed. In gamma-driven environments, price can overshoot targets rapidly, but it can also reverse just as quickly. Locking in gains incrementally reduces exposure while preserving upside participation. This approach accepts imperfection in exchange for survival. Volatility itself must be treated as a variable, not a surprise. As volatility increases, risk models must adjust. Stops that are too tight become liabilities, while stops that are too loose become irrelevant. Dynamic risk management adapts to changing conditions rather than clinging to static rules. This adaptability is what separates professionals from reactive participants. The market does not reward rigidity when conditions are fluid. Another critical hook is understanding correlation risk. During periods of stress, assets that normally move independently can suddenly align. Silver, equities, currencies, and derivatives may all respond to the same volatility impulse. Risk management must account for this convergence. Diversification that works in calm markets can fail when volatility spikes. Recognizing this prevents false confidence and encourages more conservative exposure during unstable periods. Psychological risk is often underestimated. Rapid gains can distort perception, leading traders to abandon discipline precisely when it is most needed. Overconfidence grows, quietly disguised as conviction. Risk management counters this by enforcing rules that do not bend under emotional pressure. These rules act as anchors when momentum clouds judgment. In volatile markets, emotional control is not a personality trait, it is a system. Gamma-driven rallies reward those who respect their instability. The goal is not to capture every dollar of movement, but to participate without being consumed by it. Markets offer endless opportunities, but capital is finite. Risk management ensures that participation today does not eliminate participation tomorrow. In environments defined by speed and force, survival is not passive, it is intentional, structured, and relentlessly disciplined. So as the final hours count down, remember this: markets reward preparation, not panic. Whether you participate or simply observe, understand the lesson unfolding before you. 4 hours left is not just a timeline, it's a mindset. When pressure meets patience, when knowledge meets courage, moments like these redefine what's possible. Stay sharp, stay informed, and never forget, the biggest moves begin before the world is ready to believe they can happen.